In the world of investing, retail investors, individuals who invest their own money in stocks, bonds, and other financial instruments, often feel at a disadvantage when compared to Wall Street giants such as institutional investors, hedge funds, and mutual funds. These large financial entities typically have vast resources, expert teams, and sophisticated tools at their disposal. However, retail investors can still find ways to level the playing field and even outperform these titans. Here are the top 10 ways retail investors can compete with Wall Street giants. 1. Leverage technology and AI tools. Thanks to technology, retail investors now have access to a wide array of tools that were once reserved for institutional investors. AI-driven platforms and robo-advisors can help with portfolio management, automated trading, and investment analysis. These tools use algorithms to analyze vast amounts of data, helping investors make informed decisions quickly. By leveraging these technologies, retail investors can analyze stocks, spot trends, and execute trades with the speed and precision of Wall Street professionals. 2. Focus on long-term investment strategies. One of the advantages retail investors have over institutional giants is the ability to take a long-term approach without the pressure of quarterly reports or short-term performance targets. While hedge funds and mutual funds often have to show immediate returns, retail investors can afford to buy and hold investments for extended periods. This strategy allows them to capitalize on the long-term growth potential of quality companies without the need to react to every market fluctuation. 3. Avoid over-diversification. While diversification is important, institutional investors often take a scattergun approach to spreading their investments across hundreds or even thousands of stocks. This reduces the potential for outsized returns. Retail investors, on the other hand, have the advantage of being able to concentrate their investments in a select number of high-conviction stocks, potentially yielding higher returns if their picks perform well. 4. Capitalize on undervalued stocks. Retail investors can often identify undervalued stocks before Wall Street analysts catch on. Large financial institutions often focus on large-cap, high-profile companies, but retail investors can spend time researching smaller, under-the-radar companies with growth potential. By being patient and conducting thorough research, retail investors can uncover hidden gems that the big players overlook, giving them an edge. 5. Use low-cost investment options. Wall Street giants have massive resources, but retail investors can benefit from the growing number of low-cost investment vehicles, such as exchange-traded funds, ETFs, and index funds. These funds provide instant diversification and are available with minimal fees compared to actively managed funds. By sticking to low-cost options, retail investors can maximize their returns over time and avoid the high fees that institutional investors often charge their clients. 6. Stay agile and flexible. Unlike institutional investors, retail investors can be much more agile and flexible in their decision-making. While large firms are often weighed down by bureaucratic processes and slow decision-making, retail investors can react quickly to changes in the market. This flexibility allows them to capitalize on short-term opportunities or quickly adjust their portfolios in response to market conditions, something that's often difficult for institutional investors to do efficiently. 7. Tap into alternative investment opportunities. Retail investors can also explore alternative investment opportunities that institutional investors may overlook. This could include crowdfunding platforms, peer-to-peer lending, or investing in cryptocurrencies. These niche markets often offer higher risk but also higher rewards. By diversifying into these alternative investments, retail investors can potentially earn higher returns than relying solely on traditional stocks and bonds. 8. Use social media and online communities. In recent years, social media platforms and online communities have become an essential source of investment information. Retail investors can tap into platforms like Reddit, Twitter, and StockTwits to follow trends, share insights, and access crowdsourced research. These communities can help retail investors spot emerging trends, identify stocks with high potential, and share information that Wall Street giants might not consider until much later. 9. Invest in thematic and ESG stocks. Another advantage retail investors have over large institutions is their ability to focus on niche or thematic investments that align with their values or personal interests. For example, Retail investors can build portfolios centered around environmental, social, and governance (ESG) factors, which have become increasingly popular. These stocks may not always be on the radar of institutional investors, but they offer potential for strong growth as public interest in sustainability and ethical investing continues to rise. 10. Utilize dollar cost averaging. Dollar cost averaging, DCA, is a strategy where investors invest a fixed amount of money in an asset at regular intervals, regardless of its price. This approach minimizes the risk of making poor investment decisions based on market timing. Retail investors can take advantage of this strategy, especially during periods of volatility, by regularly investing smaller amounts over time. This allows them to smooth out market fluctuations and avoid the temptation to try and time the market, a strategy that often leads to mistakes for both retail and institutional investors. Retail investors may lack the vast resources of Wall Street giants, but they can use their agility, focus on long-term strategies, and access to modern technology to compete effectively. By leveraging low-cost investment options, exploring alternative assets, and making use of online communities, retail investors can build wealth and even outperform institutional players in some cases. Ultimately, it's about taking advantage of the unique strengths that retail investors possess and using them to their advantage in the ever-evolving world of investing.